Hawkish Fed risks are making us more positive on the US dollar. Instead of staying range-bound, we now expect the US dollar to strengthen modestly. The US economy continues to outperform, helped by the AI boom. Strong investment spending and rising equity wealth have widened the growth gap between the US and other economies. As a result, investors are questioning whether current Fed policy is restrictive enough. This is especially true when compared with Europe, where the benefits from AI have been more limited. With the Fed back in focus, the US dollar is once again being driven by interest rate differentials. Fed Chair Washed focus on controlling inflation has also reduced concerns about Fed independence, easing debasement risk, and supporting the dollar. Overall, we expect the US dollar to move higher over the coming months. This points to further downside for the euro dollar. We now see the US dollar rising by around 2 to 3% by the end of this year. The US dollar should perform well against low-yielding currencies such as the euro and Swiss franc. The Japanese yen could find near-term support from policy measures aimed at encouraging greater domestic investment by Japanese pension funds. But a lasting shift in the yen from a funding to an investment currency will likely require speeding up in the pace of Bank of Japan rate hikes. A US dollar gain of more than 5% is possible, but not our base case. That could happen if oil prices rise above $100 per barrel or if the US economy grows much faster than expected. Carry trades should still perform well as long as market sentiment remains positive. However, choosing the right funding currency remains important. Turning to commodities, we still expect oil prices to trend lower. Over the medium term, we see Brent crude moving towards $60 to $65 per barrel. However, the decline is likely to be gradual. Unlike the sharp drop in the second quarter, we do not expect another steep correction. Ongoing tensions in the Middle East should keep some risk premium in oil prices. Recent tensions involving the US and Iran are a reminder of this supply risk. The Strait of Hormuz remains a key shipping risk for global energy markets. Strong US exports and weak Chinese imports help limit the initial jump in oil prices, but they also reduce inventory levels. As inventories are rebuilt, returning Middle East supply should be more easily absorbed by the market. This should help keep prices stable. In short, we still expect oil prices to move lower, but at a slower pace. We forecast Brent crude at $75 per barrel by year-end, which is not far from current levels.